Good morning from hot and sunny Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, July 27th, 2025. In today's podcast, our focus is on yet another new all-time high in the S&P 500 on Friday, and just how much more upside there might be in the April rebound as the market has already risen by 32%. The S&P has risen by 32% since the April 7th low. Whenever you look at this kind of a market, you end up hearing the same thing from investors. A lot of investors were scared out of the market during the 20% decline this year from the February highs, and then were too scared to get back in during the 28% pretty aggressive rally that followed and that we're in the midst of. First, you lose money, and you go through all the anguish of wondering when you should pull the trigger and just get out of the market. And then after that, the market starts to go the other way, and you lose your courage and you lose your focus and you miss an opportunity. So it's almost like you lost twice. Systematic, data-driven investing, which during my 40-year career, the past 10 or 15 years has really been solely focused on that. Systematic, data-driven investing. It keeps that from happening to you because you're following the money. You're not doing so much, there isn't so much tension involved. All you're doing is you're following the data. You're letting the data make your decisions for you. It takes a lot of that anguish away that forces you to make mistakes. Today I'm going to show you some of our own indicators and models that we use to keep us and our subscribers and our asset management clients from falling into that trap and making those kind of emotional mistakes. Before we get started, let me give you just a little bit of information about us. Asbury Research is a registered investment advisor, an RIA. We've been providing both investment research and asset management to individuals and professional money managers since 2005, making this our 21st year in business. We have two levels of research service available. Our Asbury Premium, which is the research product that we started the business with in 2005. It includes the latest updates on all of our models, a lot of research, and some one-on-one personal instruction, typically via Zoom, that we will find out from a new subscriber how they invest, what they're interested in, what their risk tolerance is, and we'll show them how to start using our models to achieve that. We also more recently started an entry-level Substack newsletter for $25 a month. It does not include all of our trading models. Here it is here. We'll just put it up real quick. There we go. And it doesn't include our trading models, but it does include our sort report, which is a model that's exclusive to the Substack version, which is actually called Asbury Research Chart Focus. And we also have a free version of the Substack. We put the Substack out there for those where maybe our premium service was a little pricey for them. It gives them an opportunity to get beyond the free stuff that we offer on the internet and just get a little bit more information about us. So there's a free version of this service. So if you like our videos and our approach to markets, I strongly suggest that you go right here, asburyresearch.substack.com, sign up for the free service, and you'll be able to get a little bit more of our work throughout the course of the week. We also have managed accounts for both individual investors and also financial advisors, and for portfolio managers as the third-party advisor. We're starting to do a lot more business as a third-party advisor and managing some of the AUM for RIAs that are looking for the kind of models that we have. We offer 4 different model portfolios through our managed accounts that we've built with various pieces of the Asbury Research models. 3 of them so far this year, Asbury Aggressive, Asbury Balance, and Asbury Conservative are all outperforming the S&P 500 and with lower drawdowns than the S&P 500. Our Asbury Ultra Conservative model, which is the fourth one, is trailing the S&P 500 by 1.2% a year to date rather. But the maximum drawdown on this particular one was only 6.2% compared to 18.9% for the S&P 500. So the drawdown was 2/3 less than somebody experienced if they're a buy and hold investor in the S&P 500. So if you're an older and more risk-averse investor, ultra conservative model may be a great way for you to be able to play the game and stay in equities and not be stuck in treasuries, but be able to get a little more juice with equities and still have a lot of your downside risk taken away. Contact us via the contact tab here at asburyresearch.com to request more information about these model portfolios, and we can also show you the prospectuses on these. Since we're talking about drawdowns, we built a chart here this week that I wanted to share with you. So you hear me harping about how important it is to have lower drawdowns. As you can see, I'm an older investor, and many of our clients are also older investors, and these are the folks that really should be concerned about this chart. When you're in your 30s, you're dollar cost averaging. You got lots of time. I always use the football metaphor. If you're in your 30s, it's like you're in a football game and you're in the first half. You can make in the first half, you can make a lot of mistakes. You take a lot of chances and still be just fine. There's a lot of game left. Once you start approaching your 60s, you're now metaphorically in the fourth quarter of that football game. And if you've been investing for a while, you probably have a lead. You're probably playing with a lead. So just like in football, if you take a lead going into the fourth quarter, you take what the defense gives you and you don't make any mistakes. You're not throwing the ball up in the air a lot. You're just trying to grind away, add to your lead, and not have a big mistake. Here's where the drawdowns versus the required recovery comes in. If you draw down 10% in the S&P 500 or in any index, in any investment, any equity, you got to make 11% to get back to where you were. That's not a big deal. You draw down 20%, you got to make 25 on the way back to get back to even. 30%, you need to make 43%. That's a lot more. The last 30% that we had, COVID was 34%. So that's something that you can equate this to. If you draw down 40, you got to make 67 and so on. So this is why we're so focused on drawdowns. The stock market's a unique animal in that it has an inherent upward bias. I come from the commodity space on the floor of the CME, Chicago Mercantile Exchange, back in the 80s and 90s, and in foreign exchange, and in a lot of the commodity markets and interest rates. The long-term chart looks more like a sine wave. If you look at equities, long-term equities, the Dow, the S&P 500, going back 100 years, the market generally goes up. So we want to use that inherent bias upward, and that's how our models are built. Now let's look at some of our tools. So let's go back here and have a look at the Asbury 6. Most people know us by the Asbury 6. It's kind of become our signature indicator, our signature model. So what is the Asbury 6? The Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse metrics, which we selected via quantitative backtesting. What does that mean? It means I wanted to get a better daily under-the-hood look at what the real health of the market is than looking at the S&P go from up 100 today to down 100 tomorrow. So we took all of the tactical tools that I have had success with throughout my career. We started to back test them in sets, 3 sets of 4, trying to come up with something that would be a little more robust and giving us a good idea of where the market is. So 4 or more of these 6, which are the rate of change, relative performance of stocks and high yield bonds, investor asset flows, volatility, trading volume, and market breadth. It's a pretty robust look at the under the hood health of the market. When 4 or more of these are green, the model's positive. It's been positive now as of June the 23rd. And if you look back here, outside of just about a week between June 17th and June the 23rd, we've really been back in the market since April the 23rd of this year. And you could see we got out once on D16th of last year and got out again on February 21st. So we missed most of the downside. I think the downside here in the A6 was only 6 or 7% compared to 19% for the S&P 500. So we're avoiding drawdowns. So right now, all of these are green. That means internally the market is strong. There's no reason for us to start removing equity exposure. This is updated every day within the research center of asburyresearch.com, and that's behind the paywall. So year to date, the A6 has outperformed the S&P 500 by about 2%, but again, a lower drawdown, an 8% lower standard deviation, and less than half the beta, which means the volatility within the Asbury 6 is much lower than the overall market, which indicates more consistent returns with lower risk. The downside for some investors with the A6 is it's active. It trades about 11 round turns per year annualized since Q4 of 2017, which is almost 8 years, almost an 8-year look back. A round turn is going from 4 green to 4 red. So about 11 times a year, let's call it once a month. Some years there'll be more and some years there'll be less than that. But the takeaway here is there is no immediate indication that the market is losing its internal strength. So we've been long since the end of April, and we still are. So the next question is, now that we know we should be in the market because the internals are strong, is what should we be invested in? And for that, we look at our SEAF model. SEAF is an acronym and stands for Sector ETF Asset Flows. So the SEAF model is a completely data-driven sector rotation model. We built it to quantitatively identify long overweight opportunities in U.S. market sectors by following the velocity of money as it moves around these 11 sectors, which if you put them all together, it's the S&P 500. SEAF is always fully invested in the market, providing investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. Most investors always keep a portion of their money in the market. More often than not, it's in the S&P 500 or something vanilla. It might be the S&P 1500, and they keep that piece always in the market. This is a dynamic replacement for that piece. It's going to the places where the assets are flowing the fastest, and it's going away from the places where the assets are flowing out of the fastest. So right now, those of you that follow this every 2 weeks know that since April the 28th, we've been in technology. It's been one of the top 3. We're always invested in the top 3 for this model. This is the first time in the past 13 weeks that technology has fallen to number 4, and it's been replaced by utilities up top. So let's take a look at what's happened during that period. So just so you can get a visual of kind of what we're doing here. So on April the 24th, the SEAF model, XLK, it moved into the top 3 for the SEAF model. Here's April 24th here. Since then, outright, XLK has risen by 26% and change, 26.33%. Meanwhile, XLK has outperformed SPY, which is the ETF for the S&P 500, by a little over 9%. Okay, so we are out of there now. Here's another chart. Part of our SEAF model is our rainbow charts. And let's find our rainbow charts back here. Here we go. So each of the 11 have its own rainbow chart. This is a 12-month daily look back on what the ranking score was for all 11 sectors. So here's technology. Here's April the 24th right here. You can see it moved into favored. That's the green. The neutral is yellow and the avoid is red. So according to the SEAF model, it moved into favored status on April the 24th, right here where my mouse is. And if we take that down, those flows, which gave us the favored status, it gave us all of this relative outperformance. So we're still in favored status here, but we fell out of the top 3 according to the model right here. So we are no longer in technology, and we'll see what happens from here. Interesting to me that utilities is typically more of a defensive place to be. Utilities has actually had a very good year this year so far. It had some nice outperformance early in the year when the S&P was falling. So we'll see how this transpires. We'll probably talk about this in our next one, which is going to be 2 weeks from this morning. The next thing we want to look at is 3 key charts that I think are worth paying attention to. This is from one of our standard reports. It's Keys to This Week. As the name suggests, it's weekly, and we look at probably 100 or 150 charts, and we find 10 that we think are the most germane and likely to be the most influential ones to pay attention to right now. So this first one is the SOXX ETF. SOXX. It tracks the PHLX Semiconductor Index, which is semiconductors, obviously. And we see up top the outright chart, the price chart. It's moved up over its 200-day moving average on June the 4th to give us a major uptrend here. This is the part that I don't like. It's been up above its 21-day moving average here since April the 24th, indicating monthly outperformance. It gave us all of this rise in the SOXX and a coincident rise in the S&P 500. Since July the 22nd, however, SOXX is now underperforming the S&P on a 21-day monthly basis. That means it's losing some of its leadership. It still is getting outperformance from technology, but semis often lead tech. So we're watching this relative underperformance and hoping, well, there's no hope in investing. I hate to use that word. We're watching this closely as a possible leading indication of more relative underperformance, maybe starting to trickle down into the NASDAQs. So this is important to us. This is something to watch for the next 2 weeks. Next, VXX is it's a kind of a derivative of the VIX. It's called the iPath Series B S&P 500 VIX Short-Term Futures ETN. That's quite a mouthful. But all this does for me is it kind of smooths the VIX out a little bit more so it isn't so choppy. What I'm looking at here is down here around 40 in this metric is extreme complacency. We saw it in July of 2024, which coincided with the top in the S&P. We saw it again in the beginning of December of last year. Also coincided with another top right around these 5. February 19th, we had another one. That was a really important top. And look where we are now. We're closing in on 40. That makes me a little bit apprehensive as to how much further the S&P can go higher until the market gets complacent enough to where it's going to start to generate some kind of a peak. So again, it's not actionable. The A6 is all green, but these are key metrics to pay attention to. Certainly we're going to be paying attention to them in the weeks ahead. Finally, seasonality. Seasonality to me is tertiary. I'm not going to make a trade on seasonality, but when I'm looking at the SOXX starting to underperform the S&P, when I'm looking at the VIX starting to get a little too low, complacency getting a little bit too much of a factor, and I see that August and September are the 9th and 12th strongest or the 4th and 1st weakest months of the year in the S&P 500 based on data going back to 1957, which is the origin of the S&P 500. Put all these 3 together, and this makes me a lot more reliant on what might happen in the Asbury 6 in the days and weeks ahead. The next thing we're going to look at, so we talked about the SORT report, and that is a part of Asbury Research's chart focus. That's asburyresearch.substack.com. It's $25 a month. It's kind of an entry level to our more professional services. So let's look at the SORT report. What this is, SORT actually stands for Strategic Opportunity Radar Tracker, but it is a giant sorting machine. We look at a lot of stuff here. The SORT report tells us which parts of the global market have positive trends, are outperforming their benchmarks, and have a positive asset flows, which means that new money is pushing their prices higher. This is a very low-cost way to make better investment decisions that are based on data and not opinion or economic forecast. Remember, forecasting is a euphemism for guessing. We believe in following the money. Have a look at this. The only one right now that has green all the way across, kind of the three-legged stool of trend, relative performance, and money flows, is crypto. For crypto, we are looking at the ETF Grayscale Bitcoin Trust, GBTC. So technology was here the last time that I was with you, 3 across. So was global equities X the US. Those have gone away. Right now, the only one with 3 across, the only one that is showing that it's clicking on all cylinders according to how we look at markets is crypto. Finally, last Wednesday, let's get back here. Last Wednesday, July the 23rd, my son Jack and I presented Asbury Research's 2025 mid-year outlook to about 3,000 Fidelity investment clients, people that are investing through Fidelity. If you'd like the PDF slide deck of that presentation, visit asburyresearch.com, which is where we are right now. Use the contact tab to ask for it. You can do that by typing Fidelity PDF in the text box that is inside the contact tab. This upcoming Thursday, July 30th, for those who like to follow me around the internet, I will be host Dave Keller's special guest on his popular Market Misbehavior podcast. Dave and I go way back from when he was the managing director of research at Fidelity Investments in Boston. And my firm, Asbury Research, was providing research, market analysis, and investment ideas to Fidelity at that time. So we always have good conversations. We talk about the markets. I hope you'll join us there. So there it is. That wraps up our latest Asbury Research Following the Money podcast. Our next one is tentatively scheduled for Sunday, August the 10th. For questions or more info on any of the research, any of the models, any of the model portfolios we talked about today, just go to asburyresearch.com and use the contact tab and tell us what you're interested in. And last but not least, please like and subscribe. Have a wonderful Sunday. We'll see you in 2 weeks.